If you know everything that I'm going to talk about today about these 5 areas, then that could be a sign that maybe you don't need to pay a fee to work with an advisor. Maybe you don't have to pay that 1% assets under management fee that advisors charge. And so in today's video, we're going to try to give you a checklist of things to check off or see maybe, hey, that's something I'm not as comfortable or confident in. And if so, maybe that makes sense to look at working with a team. But we see a lot of people who work with us, a lot of people who come from this channel who explore working with us, who we call extreme DIYers, which is obviously do-it-yourselfers. And so we're going to take, what we see with all of those, of having those conversations to see the areas that maybe they don't have a plan for, or maybe the areas that they're comfortable with doing on their own. So hopefully this video will be helpful for you if that's you.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
Hi, Joe Schmidt, CEO and founder of Peak Retirement Planning. And so let's get into today's video talking about these 5 areas that people need to check off if they're thinking about DIYing their retirement. And first, let me start off before we get into these points of, I'm not here to tell you to DIY or to not DIY, but I will tell you that we get a lot of people that come to us who basically the main reasons why they want to get help from an advisor is, one, to make sure that they have someone there to be there for their spouse. And this is something that we see often where one of the spouses may know everything about financial planning and maybe the other doesn't know much at all. And I actually wrote an article that got featured in Kiplinger, and we've done another video here on YouTube on this concept of, what DIYs tell us of why they want to work with a team. So that may be a different perspective outside of the video, the checklist we're going to talk about today, that could be helpful for you. And another reason why a lot of these DIYers come to us is mostly because of our tax focus. They really like the idea of having an advisor who's staying up to date on tax rule changes, staying up to date on regulation changes, and really knowing all of those advanced strategies that many of our clients say you don't know what you don't know. And so that could be another reason why working with an advisor could be productive there. And then obviously the idea of just delegation, right? Being able to have a team do this so you don't have to spend all the time doing that as well, and you don't have to worry about it. You can live your retirement. You're going to get so many years of being able to do what you want to do. Now, some of you may watch this and you say, I love doing it. And that's one of the reasons and parts of the checklist here today, that if you love to do it, maybe that is a reason why for you to do it on your own. And we even have people who say, hey, I know I may not be able to maximize this, but I just love it so much. I enjoy it. It gives me something to do that I am going to try to do this all on my own. And if that's you, congratulations. I hope that you enjoy what you're doing, as long as you know that you can still be successful. If you make a mistake or two, is obviously going to be important. So those are some other considerations for you. So let's get into the checklist here. And the first area that I want to start with is tax planning. And so if you know all about tax planning, if you get excited, like I mentioned, about reading the tax code and reading all the changes, then maybe it does make sense for you to do this on your own. And also, let me preface this too. If you do find yourself with all these checklists and you say, hey, I want to be that DIY advisor for myself, maybe think about applying for us. We're always looking for new advisors. We've got high demand right now. We're looking for great people that want to take great care of people. We've got a great training program. So I'm half joking there, but I'm sure some of you would get a chuckle out of that comment there after some of the conversations we have. So if you do want to do tax planning on your own, then you want to make sure you have a tax planning software that's going to help you. And a lot of the people we see, Bolden may be one that's been successful for them, or something they can dig deeper. We feel personally that the softwares out there are very good and very helpful, but we've even had to create some softwares ourselves to be able to really show what we're looking for, especially with the people we have that have pensions, that have a high income in retirement. There's a lot more advanced tax strategy that comes into those higher income years of planning for different taxes, like Medicare premiums is one big one. AMT is something that could come back after the Tax Cuts and Jobs Act expires. NIT, if you have capital gains, there's another surcharge there. So just being aware of all of that, what credits, deductions you could phase in and out of, or something that you want to be aware of. But if you know exactly what I'm talking about there and you have that all under control, then again, you probably know more than most DIYers out there, and this is something that you could probably do on your own. But it is going to be helpful to have software. If you want to create your own software with Excel, it's going to take a lot of work, but there is some things that you could create in yourself, maybe in a simpler software like Excel, if you can just have the time to really go through that. And you just want to fact check it and make sure it's right after it is created, to make sure you know what you're looking at and that it is going to be accurate there. The other part of the tax planning that we always want people to be aware of is just the capital gains. And so if you feel, if you have a taxable account or a brokerage account, then this is something you really want to be aware of. And maybe you don't even have this at all, so this isn't a concern and something that you could pass that test of DIYing your retirement. But if you do have capital gains, it gets pretty tricky. We do a lot of tax loss harvesting with our clients where, maybe the Pepsi stock is up, well, let's sell it and let's buy Coke. Or maybe the Pepsi stock is down, let's sell it and capitalize on the losses and buy Coke so we can, adjust that cost basis. So there's a lot of different strategies behind that. There's some charitable planning strategies you can do with non-qualified accounts like this. You can do donor advised funds, take appreciated stocks and add it to there, get the tax savings there. You can look at, itemizing 1 year and then taking the standard deduction the years after that. So if you're aware of all those things, and those are great things to know as you continue to DIY. But just understand the capital gains management as time goes on, right? The 0% bracket only goes up so high, and then you get 15% and then 20%. So just being able to manage that, understanding the different rules up there, that when you pass away, right, you could leave it to your kids and there's a stepped up cost basis there. So being wise and smart about maybe not selling stuff off and waiting towards that. So if you're familiar with all of that, then that's definitely going to be good news for you as you look to plan your retirement. The second area where we want to pay attention to is investment management. Now, this is one that I am going to be a little more bold in. I do believe that everyone needs professional investment management. You can simply DIY this. You can go pick a handful of index funds and try to diversify it out and be good to go. And you'll probably be very successful there. History tells us that will be successful. No one knows what's going to happen investment-wise, what's going to be successful moving forward. But there is studies out there. I know Vanguard's done one that's been very popular, that if you work with a professional investment management team, you could increase your returns by 1%, 2%, 3% pretty efficiently and effectively just by doing simple things as rebalancing when the time's right, being able to follow market trends, being aware of all the taxes that go into investing and all those decisions that you make there with tax efficient income planning and those types of things. So if you don't want to pay a full fee, something we always advise people of, if you don't want to pay a full fee to get a financial planning team that does 5 pillars of planning and has everyone there in one roof and really goes deep with that client experience, then we would tell you it still probably makes sense to work with a professional investment management team. And that can be a lot lower cost if that's all you're looking for. And then you're going to get all of those items that I just mentioned included there with that fee. And so it could be even as simple as something as a robo-advisor. A robo-advisor is something that does all of those things efficiently, uses data to make decisions, and it could be a lot more effective. So that's one thing. Or, even Vanguard has a really low cost option there. I think it's like 30 basis points if I'm correct there, where you can get that, type of rebalancing and structure with some of the funds that they have there. And that could be another good option if that's all you're looking for there. But I would recommend that. Again, you don't have to. But if you want to look at all the investments and look at all the data of all the stocks, individual stocks you're invested in and all the funds that you're invested in and make those decisions of what you feel is going to be best, maybe you enjoy that, then that's something maybe I would say, hey, you're good to go on. If you like looking at the balance sheets of the companies, the profit margins, the PE ratios, those are all the different things that we look at when we make decisions for our investments of what to invest in. And also I would say that when it comes to professional investment management, something that really separates, someone like us or, another financial planning team is being able to have the software to be able to calculate and get the numbers and data that we need to make decisions. And so it's not as simple as us just going to Amazon Yahoo Finance and saying, hey, let's look at all these numbers here. No, we actually have software that spits out, hey, we want to see the 10 best companies that are in the S&P 500 that have the strongest price to earnings ratio. We want the strongest balance sheets. And so through that, we can zone in and save a lot of time in choosing which of the investments we really want to target and focus on to invest in. So that's where professional investment management can come in handy. But again, if you have the time to do that, maybe it's something you enjoy. Maybe you're okay sacrificing some return just to be able to invest in the companies that you like or believe in. And that's something that you have the privilege of doing as well. So that would be on the investment planning side of things to consider. The third area that I want to talk about is just simply income planning. And this is going to be something that, I mentioned earlier, tax efficient income planning. This is pretty difficult to do. We typically see that most DIYers have struggles with this, of knowing which accounts to pull out from in order to pay the least amount of taxes year after year. And so this could be considered, should I pull out of my Roth? Should I pull out of my traditional IRA? Should I pull out of my brokerage account that's capital gains? Making those decisions, but also when do we we take Social Security? When are we going to turn on our pension? Should we take the survivorship option on our pension so that our spouse is good to go if we pass away? Should we take the lump sum pension and have that and try to do something better with it to produce a better income as time goes? Those are all the considerations that we see. And so if you feel like those are not necessarily concerns of yours, then probably not a big deal. If you have a plan to get the tax efficient income moving forward, you know exactly how much you should be having in Roth versus an IRA to produce that income that you're looking for, that you know how to standard deduction works and how to maximize that. You understand how Social Security taxation works and to know if you're going to be phased in or out of that, if Social Security is going to be tax-free or if it's going to be taxable, and what that looks like as time goes on. And also understand how your required minimum distribution plays a part of all of this as well, because even if you don't need the income but you're forced to take it, how is that going to look for your tax scenario? Or would it make sense to do things like Roth conversions now and move that over to an IRA now, maybe at lower brackets than what it could be in the future? Those are all considerations. And so if you feel like you have a Roth conversion plan in place, you have a required minimum distribution plan in place, you have an income plan in place, then maybe you're good to go. But we do see people that do have struggles of, how do I take all these investments I've saved all these years and turn it into income? But those would be the considerations to be aware of. The fourth area of healthcare planning is something that we also want people to be aware of. And so obviously a lot of people think of healthcare, they think of long-term care planning. And I'll be very transparent with you here just with what we do. We don't really recommend long-term care insurance at this point in time. Now that could change as time goes on if the products change or the environment changes. But right now it's just very costly. And so it doesn't always make sense for most people that we work with. Again, that could be different for your specific situation. But for those who are that Midwestern millionaire that we see, this isn't something that we typically go to. But there are different ways to plan for long-term care around that income planning pillar that we just talked about. And that can involve making sure your money is protected and available from a tax standpoint to be able to access those funds in case you were going to need a nursing home or assisted living where it can cost $50,000 to $100,000 a year. So just being aware of that, knowing where to get the funds. If you've got a plan for that and you feel comfortable that if something happened there, you could self-insure and cover that, then again, maybe you're good to go there. The other thing to think about here is when you do get to age 65 and before you get to age 65. So let's say you retire early, like many of the people do that we work with, then you're going to have to maybe find health insurance if your company doesn't offer that after you retire from then until 65. And so that can be very costly. And so even if you want to DIY it, just simply go find a health insurance specialist that you can trust to help you shop the marketplace to be able to find you what coverage is the best for you. Or you could just simply do all the research on your own, but that typically takes more time and specialty. So it just kind of depends on how much time you want to spend on this. But that's something we have here with our firm, is we have a specialist help us before 65 with our clients, and then after 65 when it comes time to claim Medicare. There's a lot of decisions to make with that. If you're not retired military and not have TRICARE for life, then maybe you're going to need a supplemental plan on top of Part A and B in retirement. And so it's all about picking the right plan, making sure you get the right coverage in place so you're not overpaying, but you also don't have any gaps in your healthcare plan, because obviously that can be a huge expense throughout retirement. So maybe those are one areas you want to work with a specialist who knows the area. I know a lot of our clients tell us they love us having that in-house so they don't have to go to the steak dinner and listen to the Medicare with Muffins presentation that they have, or all the mailers that they're getting on these topics. But just making sure you have a plan for those so you don't have any gaps is going to be very important. And then something else that many of our clients are worried about is IRMA premiums. So obviously, as you know, the more you make in retirement, or the higher your income, which we see often with the clients we work with because they have a pension, Social Security, and those required minimum distributions we talked about that they're forced to take out at 73 or 75, in their later years, they could be paying a lot of money in healthcare for Medicare Part B, but they're getting the same coverage. And so this is something where we try to find ways to reduce their income so when that time comes, they're good to go. So just want to make sure you understand how that works with IRMA. And if you understand how that works, then again, you're going to be good to go there. But just making sure you do an analysis to see where your income is at now and where you're going to be expected to be at 63. And the reason I say 63 is because they look back 2 years to decide what your 65 premium will be for Part B, but also to see what's going to happen at 75 when you reach R&D age, right? And so you may not have any IRMA premium penalties now, but when you turn 75, maybe your income's sky high from your RMD that now is 2, 3, 4, 5 million from your IRA. And now when you take out 4% of that, then that's going to bump you up to those tiers. And now from 75 until you pass away, you could be paying significant amounts in increases. So this is something you want to get ahead of, but just make sure you have a plan in place for that. And then the last area that I want to make people to make sure they have a plan for is simply just making sure they're covered for estate planning. Now, you can simply, there's a few things we're going to do. We're going to talk about estate planning documents, and we're going to talk about actually having an estate plan in place that factors in taxes and all the other things that we need to make sure that when we pass our wealth to our loved ones, we're good to go. So let's just talk about the documents the first time. These are typically one-time things to get in place. Obviously, you want to update and make sure everything is good to go moving forward, but this could be involved. You could go to an attorney and get this done. We actually have an attorney in-house with our clients here that makes it really easy and gets us to ensure that we get the right documents at the right price, because we've seen sending people across town can sometimes lead to them paying way more in documents that they maybe didn't need. And so just being aware of that. Now, you could DIY your documents. I wouldn't recommend it, but you certainly could. If you are that extreme of a DIYer and you really want to have that ownership, then maybe you do that and maybe put in the comments that, hey, I did that and I'm good to go. And I'll say a little prayer for you and make sure that nothing bad happens. And the reason why I joke about that is, and it's really not joking, but I'd hate to see someone get to that last point when they have this document they DIY'd and maybe one or two things are off there, and then it doesn't get implemented, and now the estate is going to have big issues, and maybe now things are going to go to probate, or maybe your end-of-life health decisions don't get done the right way. And I hate to see that when you're no longer here, you can't go back and change those mistakes. And so at a pretty nominal cost, you can get those documents done efficiently. And you could go online and also have some, auto-templated ones created. Again, I'm not the biggest fan of those, but those could be done. Your all-in cost of those versus just going to an attorney and getting basic documents is not going to be that much difference in my opinion, especially for those that we've worked with that have been great savers. It's probably going to be worth the extra cost to get that done. But again, I know this video is all about how to help you do this on your own, so you certainly could if you want to there. But the other area we see people really struggle, this DIY crowd, is more advanced type documents. So power of attorneys, will, a revocable trust, those are all simple documents in my opinion. But if you're really looking to do advanced strategies, especially if you've got $3 million or $5 million or $10 million or more, then you're really going to have a lot more complex estate planning issues. And maybe not necessarily now, but in the future especially. If we're expecting the estate tax to go down like it's been in the past, that's been as low as $1 million, even as low as $600,000, back in I think 2000s or just before that. And so if that's going to be the case, most of the people we see, most people watching these videos are going to have to pay 40 to 50% estate tax at that time on anything above that limit. And so there's a lot of more advanced trusts that you can put in place. And so one is being aware of when that time would be to make that adjustment. The second thing is which documents would you need, right? Do you need an irrevocable trust? And if you do, you have to understand what that means and how it works. Do you need maybe look at a charitable remainder trust could be a popular strategy that we see people, utilize. And so just making sure you're aware of all these things would be the first thing. So making sure you're staying up to date on tax rule changes as that estate tax changes, but also what are your goals for your legacy? I think that's one thing that our clients really value working with us, is the fact that we're able to see things that they may not be able to see. You don't know what you don't know. So just maybe continue to do a lot of research, talk to a lot of other people, watch a ton of YouTube videos to really make sure you can see and know what's going to be something you need to be doing at that time. And you have to remember, $1 million or more, less than 10% of people are in that category. And so you just understand that the planning you're going to need is a little different. So if you're listening to Dave Ramsey or Susie Orman or any of those personal finance generalists, you're typically probably not going to find the right advice there, because they're talking to people that are not over $1 million typically. And so just be aware of that as well as you look to do your research and find your answers. And then we always want people to be aware of the widow's penalty, and also being aware of what could be considered the penalty to children of leaving them money as well. And so under the current rules, if one spouse passes, the tax cuts or the married filing jointly taxes go to single taxes. And so that can be a big deal for many spouses, because they can pay nearly double the amount of taxes. And then also they're going to lose one of the Social Security benefits, so they're also going to have less income there. And so planning for that is going to be important. Understanding if it makes sense to do some Roth conversions like we talked about earlier for that spouse, maybe deciding when to take Social Security, maybe later, so the spouse can be left with more because they get to keep higher of the two. And so making sure you're aware of all those decisions, but make sure you do the analysis now to see, is your spouse going to be good to go if you pass? And also, like I said, even further than that, even further than estate planning documents and having a plan, is even having a further plan of, is your spouse going to be able to make these decisions on their own if they are DIY? And if not, probably makes sense to find a team now, or start to find a team that she can go to or he can go to when that time comes. Would be very, very important. But you want to vet that out now, because something happens to you next week, what's going to happen there is something that a lot of people are concerned about there. And then also planning for the children, right? The kids now have to take the IRA out over 10 years, which can cause them to pay a high amount of taxes at a high income year, earning years for them potentially at that time. And so putting together a plan for there, maybe looking to leave specific accounts to the higher income children versus the lower income children, or maybe the Roth to the higher income, the traditionals to the lower, and just making it even so that they both receive obviously the same, so there's no fights. But those are all considerations that you want to make sure you're planning for there. So with that being said, that's all I've got on today's episode of Joe Knows Retirement. I hope this gives you a better feel. Again, we're all about here on this channel of helping people get the setup for success, whether that's with us or someone else. And so hopefully this video helped you if you are just looking at doing it on your own. If you go through this video and you're thinking, wow, I probably need help with a team. I think I'm to that point where it probably doesn't make sense for me to do this anymore. Feel free to schedule a time with our team if that's you. If you feel like this is the level of planning you're looking for, then we can schedule a 15-minute call and see if we could be a good fit to work together. Because we work with people just like this, people who are DIYers who've done it on their own all these years, have done very well, but maybe have gotten to a point where they don't want to deal with all of the things that I talked about today. So if that's you, go ahead and schedule time. If you're the one that's saying, I'm good to go, I've got all these things in place, then great, good luck, and hopefully these videos can keep being helpful for you. And there's a link below if you would like to schedule that time with us as well. So enjoy the rest of your day. This is Joe Schmitz with Peak Retirement Planning on Joe Knows Retirement.